Well, this is Current Yield, Grant's interest rate observer of the air, and I am Jim Grant. And with me, as always, is the great deputy editor of Grant's, Evan Lorenz.
Good afternoon
to you, Evan. Ladies and gentlemen, that was just a test to see whether Evan's there. You are here.
I'm here and mostly awake.
Evan? Excellent. Okay. Well, Evan, this is a fine kettle of fish. I mean, all the world is talking about the Fed tightening. And as I see the situation, the Fed continues to do so-called quantitative easing and to impose an interest rate of about 0% on an economy that is generating, 14% nominal growth in GDP and 10% broad money growth, et cetera, et cetera. It does seem incongruous. And do you have any message for our masters at the Fed, Evan? Are you going to just let them do what they want?
I don't think they've ever listened to me before, so I don't expect them to listen to me now. But I do think it's remarkable that we've seen like a 10% sell-off in the S&P 500 when, as you noted, the Fed still kept rates at zero and is still buying bonds. It's not like they've tightened yet.
Yeah, well, there's this jawbone business goes back many decades. People talk about the Fed. The jawbone of an ass was one comment one heard in the day about unpopular Fed chairman. But, Evan, we are not just the two of us alone here with Henry, our engineer. There are soon to be three of us. And I'm going to introduce our guest. His name, pure and simple, is Doomberg. And Doomberg is, I think, the one of the leading green chickens. That's the icon on the Doomberg Substack enterprise, which presents a field of essays for your delectation. They come out pretty regularly. I'm impressed by the productivity of the Doomberg enterprise. And the topics are eclectic. The writing is silken, and the thinking is often kind of unauthorized. So I can't imagine a better trio of accolades for a Grant's guest. So Doomberg, welcome,
Jim
to
Grant and
Yield.
Evan Lorenz. We have truly climbed the entire mountain of content creation in the finance world by finally arriving on your podcast. What a wonderful achievement. It's a real honor to be here and very much looking forward to what I know will be a thrilling discussion.
Well, this is also rather economical, Doomberg, because you have saved me the trouble of doing an advertisement for Grant's interest rate. Have I mentioned Grant's interest rate observer yet?
It's the premier intellectual, thought-provoking, bi-weekly publication on Wall Street.
Thank you, Doomberg. And back at you. I asked you on this program, Evan and I asked you on this program to talk about cryptos. I wonder if we are narrowing a little bit unnecessarily the bounds of the conversation, because if you look on the production of Doomberg on Substack, it's just a wonderful medley of contemporary themes and also a pop cultural reference. It goes from the Peterman catalog to Seinfeld to, for all I know, there's some Haydn and Mozart on there as well. There's nothing purely contemporary about it. But so let me, with all that said and mumbled, Doomberg, let me begin by asking you what you make of the contention that comes out of Fidelity Investment that we live in a Bitcoin world. Bitcoin is singular. It is the thing we have to know and to own. And if you don't, you're kind of not here. I mean, it seems so extraordinary coming from Fidelity Investment, which is like down the middle of the fairway of the financial establishment. And yet here we have Fidelity Investment telling you that this digital invisible thing is the center of the financial world.
Well, the first thing that I make of it, and this perhaps lays bare our own, they say that your experiences sort of shape you. The Doomberg team comes from industry on the commodity side, but more importantly, in the context of your question, we come from very large publicly traded companies with tens of thousands of employees. And if there's one thing we learned in that time, that there is no Fidelity. There's just people in Fidelity who get quoted in the paper. And so while that might seem like a significant comment vis-a-vis the social acceptance of Bitcoin as the new reality, I wouldn't necessarily take the entire brand attribution of Fidelity and apply it to that statement. And I say that from direct personal experience, where members in organizations I used to lead would give an interview in the press that seemed to be incongruent with the official policy of our public relations team, and handling such questions thereafter was never very pleasant. But to the broader question, we've written several pieces on Bitcoin, although we are not a cryptocurrency newsletter, as you mentioned. We kind of like to write about whatever is interesting to us, which hopefully has a high enough overlap of sort of correlation with what people are interested in reading. And one of the reasons that we've mostly stayed away from the crypto space, although when we do write, we are provocative, is because you literally can't write about Bitcoin or cryptocurrencies without kicking the hornet's nest of online trolls, especially on Twitter, where we have a very large presence. And so as a general rule, we would count ourselves as interested in the technology, skeptical about the valuation, and mindful of the high likelihood that eventually the authorities will crack down on it.
Yeah, speaking of the valuation, there's so much in Doomberg, and not the least of it are the people who read it and the links on Doomberg to those readers and those writers. And one of the links I followed one day led me to an essay called "Why Market Cap is Meaningless and Dangerous: Valuation Metric as Applied to Crypto Markets," written by somebody named Anthony Back, very knowledgeable and incisive fellow was Anthony Back. And he gives it just so people talk about Bitcoin being like formerly $1 trillion enterprise, now nearly whatever it is today. I don't know, 5 trillion, zero. I forgot. I lose track.
I'm showing 700 billion.
Okay. Here's why that's meaningless. You ready? Okay. This is from finddoomberg.substack.com or Substack. Anyway, from Doomberg on Substack. Here is a link from one of their fine essays. Why market cap is meaningless. Quote, let's say I create a token with a 10 billion supply. I develop a simple ERC20 contract and deploy it on Ethereum. And on an exchange, I then convince my friend, Evan, to buy one of these tokens for $1. Boom, there you have it. A token with a $10 billion market cap. Congratulations to me. I have now created a promising new project that has received lots of investment. And here we are talking about it on current yield. This guy is a genius.
Magic.
So so Bitcoin is $700 billion or not. But I want to prime this pump, Evan and Doomberg, by reading just this final paragraph of the individual at Fidelity who wrote this thing. All right. Quote, traditional investors typically apply a technology investing framework to Bitcoin, leading to the conclusion Bitcoin as a first mover technology will easily be supplanted by a superior one or have lower returns. However, Bitcoin's first technological breakthrough was not as a superior payment technology, but as a superior form of money. As a monetary good, Bitcoin is unique, and so forth. So but the Zero Hedge says, mic drop. That's the end. That is the culminating, unarguable, unanswerable conclusion. Of the guy at Fidelity.
Who was quoted in the paper, yeah. So my response to that, and I think you're dancing around the key topic of one of our latest pieces, and by as we sit here is our most widely read piece, and it's a piece that we called Dollars Ex Machina. And even in articulating the question, you made the sort of sleight of hand, which I know that you understand that you did, which is quoting the price of Bitcoin in dollars. And we argue that, especially outside of the United States and for the balance of the trading volume in which Bitcoin is transacted, it's not actually traded in dollars, it's traded in stable coins, predominantly Tether. And what's a Tether worth is an interesting question. And in that piece, we still have never sort of received what I would call definitive and constructive criticism that changes our mind. We've received a lot of criticism. But in that piece, we draw the mental experiment that we did many years ago when we first invested in the crypto space, where we draw a box around the crypto universe and ask ourselves the question, how much crypto is in that box? How much fiat is in that box? An important distinction. And maybe for the rest of the conversation, we just talk about US dollars and assume that we mean US dollar equivalents. There might be some euros and some yen and some won in that system. But there's a box of the crypto universe, and there's a certain amount of fiat floating around in that box. But as we know, price and value can have wildly different meanings. And if you imagine that there exists an ability to print unbacked casino chips, and then these casino chips are used to trade the same Bitcoins back and forth to each other, we could raise the price of Bitcoin. But I would argue, and we argued in that piece, that the value, if you decide to use fiat currency as the framework through which you do the analysis, is bounded by the amount of fiat that's in that system. And that's a question, when I ask it to the Bitcoin maxis, I've not yet gotten a reasonable or satisfying answer to, which is, you can say that Bitcoin is worth 700 billion, and let's say the entire crypto universe is worth what, 1.5 or 2, or depending on whatever the day it is that this podcast gets released. How much actual hard fiat, which I know would be the ultimate oxymoron on this podcast, but for the purposes of this comparison, it kind of fits. How much hard fiat is floating around in that universe, and how much of the quote unquote mark-to-market valuation that we see in the paper is genuinely reflected in what an investor could reasonably take out if everybody decided to do it at the same time.
I was going to say that, Evan, you were, I think, one of the very early critics and askers of incisive questions about Tether. Have you been ever satisfied about what it is, or what's behind it?
I'm satisfied that I wouldn't put my money there. In every other regard, I'm not. The ironic thing about Tether is it essentially became a central bank within cryptocurrencies, which is ironic because whoever the person or people behind Satoshi Nakamoto was created cryptocurrencies specifically as a reaction against central banks printing money in unlimited quantities and otherwise infiltrating or manipulating the markets. But for all intents and purposes, it does seem like Tether is kind of a central bank within the crypto land. It appears to print its own liabilities, which are Tether. There's a growing amount of evidence that they may print these unbacked, and they dramatically increase liquidity within the crypto universe, which increases prices. But at the same time, it may be doing so with artificial liquidity.
Yeah, so I agree with that take, Evan, and we actually have one could apply a cynical lens to what's going on, and we wrote a piece very early on that nobody has read, it was a piece involving what we believe is sort of at the heart of what might be occurring, and it was a piece that made some speculations about if we wanted to create a giant fiat confiscation machine, how would we go about doing it? The piece was titled "A Crypto Field of Dreams." Build it and they will come sort of reference, and it was published all the way back on May 30th, literally in the first month of Doomberg. We had barely hatched out of the egg when we wrote this piece. When I look at the amount of leverage that the exchanges, who happen to be, the big exchanges overseas that happen to have close relationships and cross ownership and cross investment with Tether and Bitfinex and so on, when they induce people to take a significant amount of leverage, we believe all they're really doing is, let's walk the audience through an experiment. Jim Grant deposits $100 into an account and is credited with Tether, 100 Tethers. And then Jim Grant is then allowed to speculate in Bitcoin with 10-to-1 leverage. It doesn't take much of a move to wipe out Jim Grant's equity, quote unquote, in this context. And so you can essentially confiscate Jim Grant's fiat by convincing him he just made a bad trade. And there are very few, very large players that seem to have unlimited access to Tethers. And these exchanges happen to know your positions. And you see these large volatility gyrations in cryptocurrencies all the time, where they're literally called liquidations. But your original $100, and the point of the piece, Dollars Ex Machina, is we have a follow the fiat mindset. You deposited $100. You were credited in Tether. You were induced to speculate with 10x leverage. The position moved 10% against you. You think you made a bad trade, when in reality, it's probably a tilted house. And your $100 is gone and is split amongst the thieves. And that's sort of the way we look at it. Now, again, we'll get lots of pushback on that, but I haven't seen too much evidence against that hypothesis. And in science, a hypothesis only fails when it's properly nullified.
I'd actually like to draw on your work in the dollars ex machina piece because, again, I encourage listeners to actually read it because you try to trace how fiat flows into the crypto universe and flows out to it and kind of what the meanings are. But one thing we've noticed in the last 3 or 4 months is that there's been an extraordinarily high degree of correlation between cryptos and other risk assets. And in fact, in many instances, it appears that cryptos are leading sell-offs. Like when the market opens up and S&P goes down, cryptos have already sold off hours or even, a day beforehand. Do you have a sense of how digital currencies have become so entwined with the broader financial markets and what is the mechanism through which they seem to be tied to, I guess, worries about the Fed, worries about inflation, and kind of the sell-off in unprofitable tech?
So, like anything, what makes a particular investment bank, say, systemic from a risk perspective? Well, if you are a very large speculator in cryptos and you also happen to be similarly inclined to speculate in the sort of the deals on offer in the NASDAQ where you can buy pre-revenue companies at infinite times sales, there's going to be some cross ownership and some correlations that drive behaviors, especially in the face of a margin call where imagine you speculated with 10-to-1 leverage and you wanted to raise some fresh US greenbacks to go and buy some more tethers to speculate in the casino. So we do think there's a lot of that. But the point of dollars ex machina actually is this concept of, the line that got everybody annoyed in the Bitcoin community was we said, and everybody sort of forgets the precursor to that line, if you use fiat currency as your determining framework, it's pretty undeniable that the Bitcoin/crypto ecosystem has many, many elements of a Ponzi. In other words, they need a constant inflow of fresh fiat to hold the entire enterprise up. And then if you think, if you agree with our Crypto Field of Dreams piece, where you sort of view this as a fiat confiscation machine, well, the insiders know when the big collapse will come, and they'll be the first to grab the dollars and go out the door. So your particular question about the correlation with other risk assets, I think, is just a natural consequence as more and more new players bring new money into the system, and then they sort of cross-pollinate between markets. But our main piece, and their main point of dollars ex machina was that if you just follow the fiat, you learn some interesting things. So
I'd like to ask a follow-up if that's okay. So cryptocurrencies, as you pointed out, kind of have become more entwined with kind of broader risk markets. If something goes bump in cryptos, is there some kind of unforeseen spillovers that might be predictable today but investors aren't thinking about? I mean, just to take one example, apparently analysts at Jefferies estimate that gains on cryptocurrencies accounted for up to a quarter of all the growth in luxury goods purchased in the U.S. last year. So a quarter of all the sales increase last year apparently were fueled by people cashing out of, Dogecoin or Bitcoin or other things that gained. And if those fall, of course, that'll decline. Are there other, I guess, things that you can see now but people aren't thinking about that can happen if crypto does go bump in the night?
So there are two main phenomena that I worry about. One is the phenomenon that you described, which is sort of the paper wealth effect. So you might quit your job because you think you're a Bitcoin millionaire. And because you're a hodler, you're not actually going to take any fiat out of the system, but your mark-to-market value of what you think are US dollars gives you the confidence to make economic decisions that you might come to regret. But the second one, which I think many people are going to confront as we hit closer to April 15th, is the tax man. And the IRS has ruled that Bitcoin is an asset. And not just in Bitcoins, but in many of the meme stocks as well. Nothing crushes you like a January decline in risk assets because you may have, especially if you're a short-term trader, paper gains against which you owe taxes. And the value of your account may be below the taxes that you owe. And the IRS is nothing if not the hardest of the hard pipes back to the fiat world. And so if you are a frequent trader in a crypto space, all the rules that matter, like wash trading and paying short-term capital gains and the limited abilities to take short-term capital losses depending on your trading pattern, I do fear that there's going to be a wave of shock and disappointment on the part of people who perhaps don't really understand how serious the IRS is about collecting its fiat.
Here is the legends printed at the bottom of the 1040 form. So this is 2020, but I dare say the same language is there on 2021 model. Quote, at any time during 2020, did you receive, sell, send, exchange, or otherwise acquire any financial interest in any virtual currency? Yes or no? There's no maybe. There's no. I did, but I regret it.
Yes, I have
no,
I have confidently answered no to that question. Yeah.
Yes, but I read on Doomberg itself. Doomberg, I read that you and your team were not no coiners from the start. That you, in fact, were with this close to a
Yes.
Lamborghini. The Green Chicken team was, and then you just couldn't pull the trigger to get out.
As that piece makes clear,
do
we invested in the equity stack of a company that was participating in Bitcoin.
Oh, I see. Okay, I didn't mean to.
So
I didn't mean to cast
I was
aspersions.
totally within the bounds of the laws when I answered that question with what we like to say is an affirmative no. And so we were lured into the Bitcoin universe from a very good friend who's a brilliant guy. And as one does in venture investing, if you could get in on the seed round, oftentimes you can make many, many multiples of your money. And we literally got in on a seed round that was at some ridiculously low, basically cash valuation. And then the Bitcoin went bananas in 2017 phenomenon rolled out. And just to give you some sort of round numbers, our modest investment, which was the minimum allowable investment in that seed round, at one point, based on various transactions, was valued on paper at 600 times what we put in. And in that very moment, I turned to one of the partners in our firm and said, I will sell you this investment right now for twice what I put in it. And they declined. And so ultimately, when Bitcoin crashed, the company went defunct. And nothing screams value like the piece of paper in our drawer that lays claim to the equity stack of a company that no longer exists.
I got some of them.
But at its peak, that was if we had been able to find our way back into the fiat world, we would have multiplied our net worth severalfold.
I'd like to throw out one thing just in terms of the tax issue you said, which is that a lot of people are sitting on realized gains from last year and have unrealized losses this year, or perhaps even realized losses, but again, separate tax years. Back in the crash in 2008 and 2009, a lot of hedge funds had kind of a similar problem, which was their long books had a lot of unrealized losses and their short books had a lot of unrealized gains. So at the end of the year, nobody covered their shorts because nobody wanted to stick a tax bill and poor returns to their LPs. But in the first week or two of 2009, everyone covered their shorts that had worked, which led to an incredible trash rally for a week or two before the markets ultimately bottomed in March. So these tax considerations can have
much
large
like
swings.
What we wrote in the piece, we are very interested in what we call hard pipes out of crypto universe denominated in fiat. And the one that we highlight the most, of course, is Michael Saylor at MicroStrategy. And the fact that he has not only taken all of the cash out of the company that he is both the CEO and the chair of the board of, but went further and issued both convertible and then senior secured bonds to buy even more Bitcoin. And we make the point that those bonds can't be paid back in Tether and represent a future need to extract fiat out of the crypto universe in the unlikely event that he can't somehow refinance them when they come due. And similarly, we talk about the president of El Salvador, Bukele, who has real fiat obligations due and appears to be trying to entice enough new fiat to come into the crypto universe so that he could sell a Bitcoin-backed bonds and then use the proceeds so raised. The sort of cover story is they're going to build this fascinating place called Bitcoin City, but we hypothesize that this has more to do with the desire to get out from under the thumb of the IMF and to pay back their obligations using the fiat of the next sucker at the table.
Is it a wise thing to build Bitcoin City in the mouth of a volcano? I guess that's another question. You know, I think to me the dubious nature of the Bitcoin idea begins at the at the starting line, and because the founder, Mr. Nakamoto-san, built it on the denial of trust. And so you don't trust, you have no custodians, you don't trust them, no collateral agents, no transfer agents, we don't like them, no banks, especially no central banks. But the entire growth of the institution of credit, which has been one of the drivers of economic and development and of human betterment over the course of the last few centuries, was built on trust. I mean, these founding banking families, Glynn and Rothschild and Coote, it was all about them building a sense that they were good for their word, they were relied upon, they were substantial people, they would honor their obligations. And is the world really going to reinvent that model to to deny the existence of of trust in a transaction? It seems to me from the very first premise is a doubtful project.
We don't get into that in the piece, but I'm happy to speculate on it here. What you're referring to, of course, is this need for proof of work to validate transactions on the blockchain, which is not only sort of energy intense, but one of the things we sort of mentioned in the piece is that it also actually requires hard fiat because you can't pay your electricity bill in Tether, at least last I checked, nor in Bitcoin. And so roughly speaking, by, something like $1 billion worth of fresh fiat that needs to flow into the crypto universe every month, because this electricity bill needs to be paid, and Bitcoin mining is not a super high margin business. There is profit in it for sure, which is why people do it. So there is this sort of flow, and again, if people got upset when we used the word Ponzi to talk about the flows, we meant that in the least offensive way possible. There are plenty of Ponzis in the world. Well, just how about we go with agnostic Ponzi? And it's just, but that's literally the piece that we mentioned in the article. And this all works fine as long as anybody who wants to redeem and leave crypto universe with fiat can do so, and it works fine as long as not too many people want to do it at the same time. And it works fine as long as new money keeps coming in. And so one of the ways that you can analyze the phenomenon of non-fungible tokens, the NFT space, a cynical one, I would be the first to admit, is that this is essentially a scheme to get artists to deposit fiat into crypto universe so that they can then buy, Ethereum with it and go ahead and claim their NFTs, and trade in their NFTs.
They probably picked the wrong economic cohort to really infuse the marketplace with dollar bills. So, at least they didn't try freelance writers. I suppose it would be worse. You mentioned this proof of work business and the energy intensiveness of Bitcoin. James Robertson Jr., who works at Grants, has come up with a fine piece that will be out as we speak, just in a few hours, but it'll certainly be available by the time this podcast is available. And in it, James points out that Ethereum and a host of next-generation crypto networks are leaving behind that model, the proof of work, and they're going to do something called proof of what?
Stake?
Proof of stake, right? Yeah. And the energy cost to this portion of the Ethereum evolution is going to represent a drop of 99.95%. Which is to say a whole lot of energy cost is going out of the system because of the advance in operating protocols and systems. So I think the Bitcoin evangelists, these zealots, remind me nothing so much as kind of a gold standard person, who just insists that the way it was is the way it must be and will be. I don't mean to point fingers at gold standard people. In fact, you could hit one sitting on this podcast with an ashtray who's sitting very close to. But it's possible, we think, that Bitcoin is fast becoming a dinosaur, and that the visionaries who were in at the beginning are fast risk becoming Luddites. So the arc from technophile to Luddite in this business is about 6 months. And maybe that's going to come upon.
Michael Saylor would say one Bitcoin is one Bitcoin, and all of that is sort of FUD. All of this flows from the desire to quote the value of these tokens in traditional fiat. And once you sort of alleviate yourself of that constraint, then you're left with utility comparisons. And the technical, I would say there are many, many really smart people working on serious technical innovations in the hope of creating the perfect digital money. Whether or not Bitcoin on a technology basis survives is completely and totally different. So for Bitcoin will always exist. It's literally nothing more than software. I mean, but this is where people, your particular claim to Bitcoins can be lost. But at its core, one of the big sleight of hands is conflating value of the technology with price. And, orange coin go up, orange coin higher is sort of all part of the cult aspects of Bitcoin. There is, within the subset of the crypto participants, there is unquestionably a hardcore set of Bitcoin maximalists. We argue in the piece that these people believe in many of the same things we might believe in, that the current fiat system as operated by the banking cartel is criminal and destined to fail. We are very sympathetic to some of those arguments, but those arguments need to be separated from the value as quoted in fiat of Bitcoin. And then on top of that, as you point out, once you sort of open the door to alternative forms of money, you immediately begin to question the power of the state. And on top of that, what is the problem that's trying to be solved? So, for example, we would argue if people could freely transmit money all around the world with zero know your customer or anti-money laundering constraints, there wouldn't be much need for cryptocurrency. The actual technical underpinnings are really all oriented around solving that problem, which, by the way, we may be sympathetic to. You might be like a total libertarian and say, if you were able to get away with selling drugs, then you should be able to, spend that money as you see fit. We have anti-money laundering and know your customer rules for a reason. The reason those rules exist is because the state has decided it would like to impose its power. Many could argue that that power is illegitimate or corrupt. We would be sympathetic to those arguments. We take all of those things as axioms. We concede those points in the Bitcoin debate. We come at this as sort of more or less agnostic observers of the market and say, by the way, the state is going to do something about this. For example, the IRS is going to put you over the barrel when it comes to your 2021 taxes, or they may shut Tether down, and so on and so on.
Let's talk about something a little bit more perhaps edifying. So these days, it can be hard to find and hire the right candidates for your small business. That's why LinkedIn Jobs made it easier to find the people you want to talk to faster and for free. Well, just create a free job post in minutes on LinkedIn Jobs to reach your network and beyond to the world's largest professional network of over 770 million people. Focus on candidates with just the right skills and experience and use screening questions to get your role in front of only the most qualified. Then use the simple tools on LinkedIn Jobs to quickly filter and prioritize who you'd like to interview and hire. It's why small businesses rate LinkedIn Jobs #1 in delivering quality hires versus leading competitors. So LinkedIn Jobs helps you find the candidates you want to talk to faster. Did you know every week nearly 40 million job seekers visit LinkedIn? Post your job for free at linkedin.com/yield. That's linkedin.com/yield to post your job for free. Terms and conditions apply. Well, the reason I think that that Bitcoin and many of the others trade in lockstep with the NASDAQ 100 is because the cryptos have been integrated into the Wall Street superstructure. So it was the case that Bitcoin was kind of renegade money, and if you wanted to buy a surface-to-air missile, that's where you went to transact. But now the hodlers must pay their taxes. The margined hodlers must be marked to market. Normal tax withholding rules must apply. You need to clear, you need to settle, you need custody, you need to record, and you need to report.
Well, you're missing the most important need, which is you need more fresh fiat.
Wait, I wasn't finished. Wait,
Yeah. Doomberg, there is one thing I'd love to draw you out in, because you said that you're agnostic. You're not anti-cryptocurrencies by any means. You actually did invest in a project that you thought might have some promise. But you did say that you're not necessarily bullish on the coins, but you're bullish on the technology. I'd love to know, what is it about the technology that you find intriguing? Because the core of it seems to be a decentralized database, which is less efficient than any kind of centralized database on the planet.
Let me correct you. I said we are interested in the technology, not necessarily bullish on the technology. We are interested to learn precisely the answers to the precise question you just asked, which is, okay, what is the underlying phenomenon that you're looking to solve? And some of the technologies are genuinely interesting. Doesn't mean that we think that they're necessarily useful or advance society. It all eventually comes back to an argument that we actually are sympathetic to, Evan, which is the state has monopoly power over the money. And that power is at the core of what many perceive to be significant injustices in society. And so we are sympathetic to the motivations, but we are not unaware of the empire's ability to strike back. But vis-a-vis technology, again, we don't think that there's much going on in that universe that couldn't easily be done in the traditional system if you would just remove know your customer anti-money laundering constraints.
Yeah, plus you get airline miles in the traditional system. something else that James Robertson reminded me of in the piece that he worked up for Grant's Interest Rate Observer. He talked about all of the new entrants into the Ethereum type of blockchain application. I'm probably mangling terms. I have no idea what this stuff is about, but he points out that the Ethereum processes 25 transactions a second on average. Bitcoin is what, 5 or something?
6, I think.
Yeah. So Solana, SOLANA, 2019 vintage blockchain platform processes 1,954 a second and could handle 65,000 a second. And so it seems to me that if you are long Bitcoin, especially if a very large percentage of your portfolio is devoted to it, and you have become, despite yourself, perhaps rather an evangelist, you are basically short technology. I know that the purist would say, this is not technology, this is money. Well, it's not money because money can be lent and borrowed. And I have not yet seen the first volunteer take out a mortgage denominated in Bitcoin. Or Doomberg, let me anticipate your point, Bitcoin through Tether. But it's not money. It is software. It is something that excites the technological appetite of the world. And to be long it and unobservant or in denial about better technology seems to me to lead the way to a complete wipeout.
Well,
I mean, why should this be worth anything? Why
there's
should
lots
Bitcoin
of
be worth anything?
things trading in the world that you could ask the same questions of: paintings, gold, various stonks that have no prospect of earning their cost of capital in a sustainable way. Matt Levine makes a fantastically entertaining argument that people like to be entertained, and that there's inherent value in the casino, and being part of a community has value, and going on YouTube and talking about Bitcoin with other Bitcoin maxis has value. The world is in fact changing to be sort of more online. The metaverse, that our friend Mark Zuckerberg has rebranded his entire company around. Those can simultaneously be trends that are real, but also sort of excuses to prop up an absurd valuation. So like there's a painting on, yeah.
Well, Evan, you've talked about this, Evan. You've talked about the sporting aspect of this and what fun it is. And with Bitcoin, at least you don't have to take the weekend off. You can be all in all the time, and it's kind of a superior bouncing electric light on the Bloomberg screen, right? In that respect, it's a much improved speculation tool. Heavy leverage, all day, all night trading. You don't have to get dressed to do it.
The nice thing is the leverage is also endogenous to the system. You can get it from DeFi. You can get it from perpetual swaps that actually give a lot of leverage in Bitcoin. And if you default on a loan, there's not a guy named Vinny who comes over and breaks your kneecaps.
Just take your fiat. So let me drive this point home because it's critical, and it's one we think about a lot. We were talking earlier, Jim, about the need for new fiat. The driving force, we believe, behind the need to create these Bitcoin ETFs to get the Fidelities and the people at Fidelity to get behind this is there's a constant need for fresh money coming into the system to support the desire for certain insiders and early winners to get out, as one might say, to increase their liquidity, to quote a Chamath term. And when we look through the behavior of everyone involved via that lens, it can be pretty eye-opening. Again, we just explained sort of the view of NFTs through that lens. So in a system that does not produce any fiat, it may produce value, but it doesn't produce fiat. That system needs a constant inflow of new money. And there's a phrase for such a system. The biggest complaint we got about the piece was that we inaccurately used the term Ponzi, and that we should have called it a pyramid scheme. Okay, we think of that as a distinction without much of a difference. But nonetheless, the scheme requires a constant inflow of new fiat. And there's an interesting thing going on, which is the SEC keeps rejecting all of these Bitcoin ETFs and pointing specifically to the Tether fraud for the reason that underpins their rejection. Now, there's another couple of interesting phenomena going on. This GBTC, this Grayscale Bitcoin Trust, is trading at a substantial discount to the quote-unquote mark-to-market value of Bitcoin. Why is that? Well, there's no redeem aspects to it, so it's sort of a standard NAV fund trading at a discount to fair value. That's one interpretation. Another is maybe people are beginning to wonder whether if they truly needed to cash out, there would be that much fiat laying around for them to pick up. There's yet another little tell. The Bitcoin miners the people that are spending that $1 billion a month to keep the proof of work going, they are sitting on a lot of Bitcoin. Why won't they cash out? They're publicly traded now, like Coinbase. Everybody's trying to do an IPO. If you truly thought the future of the world was Bitcoin, why are you worried about becoming hardwired into the fiat system with real obligations and real reporting obligations, in particular to the SEC? There's a lot of hints here about what's actually going on. And look, we're the first to admit we're the old man shaking his fist on the lawn at the newfangled technology, perhaps. But there's only so many schemes in the world, and there's an awful lot of smoke going around this one.
Well, but you are an old man on a lawn shaking your fist at other old men who are in yesteryear's technology. This is the Queen Mary versus the Boeing 707, maybe, right? The short-lived contest for dominance in the transatlantic passenger business. And we think that Bitcoin is not going to turn out to be the jet in that particular competition. We are looking at the RMS.
Be prepared for an
Mary
onslaught of angry
Bitcoin.
Handwritten letters in the U.S. mail.
Handwritten? Oh, well, they're my peeps. Maybe penny postcards.
Municipal bonds trade by appointment only, and even then only sometimes. So the closed-end funds that own munis are sometimes seen as kind of proxies for market sentiment. When they trade at a large premium, maybe munis are, cheap relative to where the real marks are. And when they trade at a discount, maybe people are already implicitly marking them down. So the fact that the Grayscale Trust trades at such a commanding discount right now really is something to note.
GBTC is mark to market in US dollar. And as we've argued, and many others have as well, it's not an original idea of ours, we should say. Bitcoin is mark to market predominantly in Tether. And people get angry when we say that. Oh, Tether's not available at US exchanges. Yeah, but these exchanges arbitrage each other. And so if Tether is the predominant currency in which Bitcoin trades overseas, it has a substantial impact vis-a-vis the market structure on the quoted price, the sleight of hand of quoting Bitcoin in US dollars. GBTC literally is marked in US dollars. And we believe that's an interesting tell.
Yeah, and all of the largest exchanges, I believe, are Tether only, like Binance, which is the vast majority of trading, and also Bitcoin derivatives, which offer a lot of leverage themselves.
Yeah, you're trading Tether with leverage, but you deposited fiat when you first arrived at the casino. And so again, in that piece, A Crypto Field of Dreams, we conceived of the thought experiment of building the ideal fiat currency machine, fiat confiscation machine, I'm sorry. And it wouldn't look very much different than what we see today, we believe. And so we think, buyer beware. If you're in it to speculate and you're in it for entertainment, that's great. How much actual hard fiat is floating around in crypto universe is a question we'd love to know the answer to. And we suspect it's many, many multiples lower than the mark-to-market value of crypto that people look at on their phone and think they actually could access that in the form of US dollars.
In conclusion, Doomberg and Evan Lorenz, I would say that the more I listen to this learned conversation and the more I hear the word fiat being spat around, the more I am coming to suspect that the entire crypto project is a nefarious scheme by the United States government to make fiat currency look good.
Deep.
Think about it. Until next time on Current Yield, ladies and gentlemen, Doomberg, thank you for being with us. This is delightful, and I hope you'll come back again and again. We only have begun to scratch the surface of the Catholic and wide-ranging interests of the Doomberg team. We go on Substack and look at what they have written. It's delightful in style and provocative in subject and worldview. So thank you. And Evan Lorenz, I'm glad you're at Grants, Evan. I listened to you talk. I think there's a future for this enterprise. So ladies and gentlemen, thank you for listening. And until next time.